Welcome to the Explainer. Okay, so something big is stirring in the market's deepest waters. We're tracking what's being called a tech whale, this massive force of capital that's suddenly changing course. And let me tell you, its next move could create some serious waves for everyone. I love how the source material puts this. The tech whale is surfacing to take a breath, or, in market talk, to take profits. Now, this isn't just some minor sell-off. It's a signal, a big one. So let's figure out what it really means. And this really begs the question, right? When the biggest, most powerful force in the market suddenly changes direction, what on earth happens to everything else? We're going to follow this huge shift, this migration from high-flying tech into some more traditional sectors and see what kind of fallout it might cause. Okay, so first things first, let's get our main term straight. What we're witnessing here is a market rotation. And this is not just random buying and selling, okay? It's a very deliberate, strategic relocation of billions, maybe even trillions of dollars. It's basically the smart money saying, all right, that party's over, but this other one over here is just getting started. So why now? What's actually causing this massive shift? Well, the source material points to three really powerful forces at play, which it calls gravity, gaps, and greed. Let's break each one down. The first reason is this sort of macroeconomic gravity. Think about it. As the return you can get on super safe government bonds goes up, it acts like a giant magnet, just pulling capital away from those riskier, high-flying tech stocks that, frankly, suddenly don't look quite as shiny. And at the very heart of all this is one single powerful number, the 10-year Treasury yield. Just think of it as the market's risk-free rate. When this number climbs, the whole equation for investors changes. All of a sudden, the math that was justifying these sky-high prices for tech stocks, it just doesn't add up anymore. I mean, why gamble on future growth when you can get a solid, guaranteed return right now? And that brings us to the second driver, a really massive valuation gap. Tech stocks, well, they've been priced for absolute perfection, trading at nearly 30 times their expected earnings. But meanwhile, you've got these old-school sectors like energy trading at less than half that. For the whales, for the big money, a gap that wide is an opportunity that's just too big to ignore. The final driver? Well, this one isn't about spreadsheets or numbers. It's all about psychology. And the source material highlights a pretty dangerous split in how the pros and the general public are looking at the market right now. And here's the kicker, the really crucial point. While a ton of everyday investors are seeing this recent tech dip and thinking, great, time to buy low, the big institutional whales are on the complete opposite side of that trade. They're the ones quietly selling into that enthusiasm, cashing in their profits and moving on. All right, so we've got the why down. Now, let's play detective and follow the money. Where exactly is all this capital flowing from, and where is it finding its new home? I mean, when you look at the data, it's like a clear exodus is happening. Money is pouring out of technology as institutions cash out. It is completely avoiding real estate, the source literally calls it dead money, and it's flowing out of utilities after a little rally that just didn't convince any of the big players. And where's all that cash going instead? Well, it's flowing into these more defensive, value-type sectors. Energy is the #1 target. Consumer staples, companies that sell stuff we need no matter what, that's the safe parking spot. And financials, they're holding steady, which kind of suggests the big banks think the economy can handle this shift without breaking. I mean, look at this. This defensive rotation becomes absolutely crystal clear when you just look at the numbers. Almost half of the new capital is flowing into the energy sector alone. This isn't just some minor tweak in a portfolio. This is a major strategic bet on value over growth. So what does this all mean for us, like right now, in the immediate future? Well, the source material gives us a pretty clear navigation chart, laying out the key signals to watch and the potential scenarios that could play out from here. The pros, the smart money, they are watching three key tripwires. First, energy company earnings. Are they going to deliver some good news? Second, NVIDIA, the absolute leader of the AI rally. Can it hold a key technical level? And third, the VIX, the market's fear gauge. Is it about to wake up and spike? Believe me, the answers to these questions are probably going to dictate the market's next big move. So all those signals feed directly into three potential outcomes. The most likely scenario, the base case, has a 60% chance. It's that this slow, grinding rotation from tech to value just continues. But there's a very real 30% chance of what's called a flush, a much sharper, faster sell-off. And for the bulls, Well, there's a slim 10% chance this was all a big bear trap, and tech is about to roar right back. All right, before we wrap up, there's one last thing. The source material offers what it calls a final hidden gem, a key insight that puts this entire rotation into a much broader and maybe even more concerning perspective. And this is the big one, the insight that really ties this whole thing together. Even after all the recent selling, tech stocks are still incredibly expensive by historical standards. The smart money isn't jumping in to buy this dip because they're waiting for prices to fall even more. This kind of suggests that what we're seeing isn't just some short-term blip. No, it might be just the beginning of a much larger correction. So at the end of the day, that's what this whole defensive rotation is about. It's not necessarily a prediction that a crash is coming tomorrow. It's a strategic move to de-risk, to protect capital. It's the smart money buying an insurance policy just in case the storm does hit. And that really leaves us with one final big question. The biggest, most informed players in the entire market are clearly adjusting their sails for choppier waters ahead. So the real question is, based on everything you just heard, are you?